Welcome back to the trading floor. I'm David Axtell. Last episode, we covered execution methods, voice, single dealer platforms, multi-dealer platforms, algorithms, how to choose based on trade characteristics. Today, we're digging into what execution actually costs, because spreads are just the beginning. When most people think about FX transaction costs, they think about the bid-offer spread. You see 1.0850 bid, 1.0852 offer, 2 pip spread. That's your cost, right? Wrong, or at least incomplete. The visible spread is your explicit cost, but there are implicit costs that often dwarf the spread. Market impact, timing costs, opportunity costs. For large institutional trades, implicit costs can be 3 to 5 times larger than the spread. Understanding these cost components matters. If you're only measuring spreads, you're missing most of your actual costs. And if you're missing costs, you can't optimize execution. You can't measure performance. You can't improve. Let's start with explicit costs, the ones you can see. The bid-offer spread is your most obvious cost. Dealer quotes 1.0850 bid, 1.0852 offer. You want to buy euros. You pay the offer, 1.0852. The mid-market is 1.0851. You paid 1 pip above mid, that's your spread cost. For a 10 million euro trade, 1 pip costs you $1,000, so that 2 pip spread costs you $2,000, straightforward. Commission fees apply if you're using a broker or certain platforms. Multi-dealer platforms sometimes charge per transaction. Might be $1 per million traded or $10 flat fee per trade. Small in absolute terms, but they add up over volume. Clearing fees matter if you're using cleared execution. CLS charges for settlement. Clearing houses charge margin management fees. These are basis points, 1, 2, maybe 3 basis points. Not huge individually, but part of your total explicit cost. Explicit costs are easy to measure. They're documented. They're on your execution reports. They're transparent. The hard part is the implicit costs, the ones that don't show up on any invoice. Market impact is the most significant implicit cost for large orders. Market impact means the price moves against you as you execute your order. You start buying at 1.0852. As you buy, the market moves up. Your next purchase is at 1.0853, then 1.0854. Your average execution price is worse than the starting price because your buying pushed the market higher. That's market impact, and it scales non-linearly with order size. Research shows market impact follows roughly a square root relationship. If you double your order size, your market impact doesn't double. It increases by about 40%. The square root of 2 is roughly 1.4. This relationship creates powerful incentives for order slicing. Breaking a large order into smaller pieces reduces total impact dramatically. Let's say you want to buy 50 million euros. If you execute the entire order immediately, you might experience 5 pip market impact. Your total cost is spread plus 5 pips, maybe 7 pips total. But if you split that order into 4 pieces, executing 12.5 million at a time, your impact per piece might be 2.5 pips. Total impact across all 4 pieces, maybe 3 pips. You've reduced impact by 40% just by splitting the order. The trade-off is timing risk, which brings us to the next cost component. Timing cost represents the price drift during execution. You decide to buy euros at 1.0850. You don't execute immediately. You use an algorithm to work the order over 4 hours. During those 4 hours, the market moves to 1.0860, 10 pip adverse move. That 10 pip movement is your timing cost, not caused by your order, caused by market movements while you are executing. Timing costs depend on volatility and execution duration. High volatility markets create larger timing risk, long execution periods expose you to more potential movement. The fundamental trade-off in execution is impact versus timing. Execute fast, you have high impact but low timing risk. Execute slowly, you have low impact but high timing risk. For an urgent trade, you accept high impact to minimize timing exposure. For a patient strategic rebalance, you accept timing risk to minimize impact. There's no universally optimal approach. It depends on your urgency, your market view, and your risk tolerance. Opportunity cost is the hardest to measure, but potentially the most expensive. Opportunity cost means you didn't complete your intended trade. You wanted to buy 50 million euros. You only executed 30 million before the market moved away. You have 20 million unfilled. If the market rallies 10 pips after you stop executing, you've effectively lost 10 pips on that unfilled $20,200,000 of opportunity cost. This happens with limit orders. You set a limit to buy at 1.0850. The market trades at 1.0851 all day, never hitting your limit. You don't execute. Then overnight, the market gaps to 1.0900, 50 pip adverse move. You missed your execution. That's opportunity cost. Measuring opportunity cost requires defining a benchmark. What would have happened if you'd executed differently? That's somewhat hypothetical, but it's economically real. Transaction cost analysis, TCA, is how professionals measure execution quality comprehensively. Simple TCA compares your execution price to mid-market at execution time. You bought at 1.0852, when mid was 1.0851, you paid 1 pip, done. But that doesn't capture timing costs or opportunity costs, it only measures the execution spread. Arrival price benchmark compares your execution to mid-market when you decided to trade. If you decided at 1.0850 and executed at 1.0852, your cost is 2 pips. That includes both spread and any market movement during your decision to execution delay. VWAP, volume weighted average price, compares your execution to the market's average price during your execution window. If you traded over 4 hours and the market VWAP was 1.0855, but you achieved 1.0853, you beat VWAP by 2 pips. That's good execution. Implementation shortfall is the most comprehensive measure. It compares your actual outcome to a theoretical paper portfolio that executed instantly at your decision price. Let's say you decided to buy 50 million euros at 1.0850. You executed 30 million at an average of 1.0854. 20 million never executed. The market ended the day at 1.0870. Your implementation shortfall includes executed trades at 1.0854 versus decision price of 1.0850. That's 4 pips on 30 million, plus the 20 million unfilled at end of day price of 1.0870 versus 1.0850. That's 20 pips on 20 million. Total implementation shortfall captures your full economic cost, including opportunity cost from non-execution. It's the most honest measure of what you really paid. Let me give you a real example from my time running treasury operations. We had a regular need to convert Australian dollar receivables to US dollars, typically 15 to 20 million Aussie. We'd been using a multi-dealer platform, getting competitive quotes, executing at visible spreads of around 2 pips. We thought we were doing well. 2 pip spread is tight for Aussie dollar. Then we implemented proper TCA. We started measuring arrival price and VWAP. And we discovered we were consistently executing at VWAP plus 1.5 pips. Our total cost wasn't 2 pips. It was 3.5 pips. What was happening? We were sending RFQs during the Asian session. Lower liquidity, wider effective spreads. By the time we executed, the market had moved slightly against us. We changed our execution timing, started executing during the Sydney-Tokyo overlap, better liquidity, tighter markets. Our average cost dropped to VWAP plus 0.5 pips. We'd reduced total costs by a full pip just by optimizing timing. That 1 pip on $20 million per month is $20,000, $240,000 annually, just from execution timing. That's the power of comprehensive TCA. You identify cost drivers, you make informed adjustments, you measure results, you improve systematically. Now let's talk about cost scaling by order size. Small orders, under 5 million in major pairs, are dominated by spread costs. You pay the spread, maybe you pay a small commission. Market impact is negligible. Timing risk over a few seconds is minimal. Your total cost is basically the spread. Medium orders, 5 to 20 million, start showing market impact. Maybe 1 to 2 pips additional impact beyond the spread. Timing costs become relevant if you're working the order over minutes or hours. Large orders, above 20 or 30 million, are dominated by implicit costs. Spread might be 2 pips, but market impact could be 4 pips. Timing cost another 3 pips. Total cost 7 to 9 pips. The spread is less than a third of your actual cost. Very large orders, above 100 million, require sophisticated execution strategies, algorithms, possibly multi-day implementation. Costs become highly dependent on execution skill. Understanding this scaling relationship changes how you think about execution. For small trades, just get tight spreads. For large trades, focus on minimizing impact and managing timing risk. Currency pair liquidity also affects costs dramatically. Euro-dollar is the most liquid currency pair. Spreads during London-New York overlap might be half a pip. Market impact for a 20 million order may be 1 pip. Total costs are very low. Aussie dollar, cable, dollar yen, still liquid, but not euro-dollar liquid, spreads of 1 to 2 pips. Impact for 20 million, maybe 2 to 3 pips. Higher costs, but manageable. Exotic pairs, Turkish lira, South African rand, Brazilian real, spreads 10 to 50 pips. Impact for large orders can be another 20 pips. You're paying 30 to 70 pips total. Execution strategy becomes critical. Some emerging market currencies, you simply can't execute large size without accepting massive costs. There isn't enough liquidity, the market isn't deep enough, you need multi-day programs. Voice relationships. Patience. Time of day affects costs significantly. Asian session for major pairs. Spreads are wider, fewer dealers active, lower volumes. Your execution costs are higher. Unless you're trading Aussie dollar or yen pairs, where Asian session is actually the local session with better liquidity. European session, better liquidity, spreads tighten, more competitive pricing, good execution window for euros, sterling, Swiss franc. London-New York overlap, peak liquidity, tightest spreads, deepest markets, best execution for most pairs. If you have flexibility, execute during this window. Understanding these patterns lets you schedule execution strategically. Don't execute Aussie dollar during New York afternoon when Sydney's closed. Don't execute euro during Asian night when both Europe and US are closed. Market conditions matter enormously for costs. Normal markets. Spreads are tight, depth is good, algorithms work efficiently, your costs are predictable, you can achieve VWAP reliably. Stressed markets. Spreads widen 5 to 15 times, depth disappears, algorithms struggle, your costs explode. A normally 2 pip spread becomes 10 pips, normal 2 pip impact becomes 8 pips. Total cost 20 pips when you expected 4. During stressed periods, execution strategy must adapt. More patience, smaller orders, voice relationships. Accepting that costs will be higher than normal. The worst mistake is using normal market execution strategies during stress conditions. Your costs will be catastrophic. Let me give you practical guidance on realistic cost expectations. For euro-dollar, small orders under 10 million during liquid hours in normal markets expect total costs of 1 to 2 pips, spread plus minimal impact. For euro-dollar, large orders 50 to 100 million during liquid hours using good algorithms expect 4 to 6 pips, spread, impact, and timing costs combined. For exotic pairs, small orders expect 10 to 30 pips. Large orders expect 30 to 70 pips or more. These markets simply aren't efficient enough for low costs. During market stress, multiply normal costs by 3 to 5 times. That's realistic. If your normal cost is 2 pips, expect 6 to 10 during stress. Understanding these benchmarks helps you evaluate your execution quality. If you're consistently achieving costs well below these ranges, you're doing something right. If you're consistently above, you need to improve your process. That's transaction costs in FX, spreads, market impact, timing costs, opportunity costs, how they scale with order size and liquidity, how to measure comprehensively through TCA, and realistic cost expectations for different situations. Professional execution requires understanding all these components, measuring them, optimizing them. That's what separates random execution from systematic quality. Next episode, we're going deeper into settlement risk, Herstatt risk, why the 1974 bank failure changed the industry, how CLS works to eliminate principal risk, Nostro networks and correspondent banking, the operational infrastructure that makes FX settlement reliable. Because transaction costs matter for profitability, but settlement risk matters for survival. I'm David Axtell. Thanks for joining me on the trading floor. If you're finding this series useful, subscribe wherever you get your podcasts. We release episodes weekly. And if you want comprehensive coverage of execution, costs, and risk management, check out FX Cash Products, the book Luigi Rondinini and I wrote, available through Rondinini Publishing. See you in episode 8.